Welcome to TheoTrade. This is Don Kaufman. It's December 10th, 2018, and you are watching the TheoTrade evening video. Well, just a few minutes to go to the cash close with the S&Ps up about 4 handles. But you know, if you tuned into this marketplace after the cash close, you may see, whoa, it's a rather docile day. Yeah, docile day where the difference between the high and the low over here, yeah, you got that right, okay? We're talking 60, 70 point range inside of the S&P futures. It is massive out there, people. You know, again, looking at it on a chart, on an intraday chart, just doesn't necessarily do it justice how strong some of the sell side activity was. And then we had what really has amounted to, with again, only a few minutes to go to the cash close, a yet another failed rally specific to the S&Ps. Now, the Nasdaq is going to eke out some decent sized gains, like by the tune of about 1%. But that just, again, not really doing it for us when you start to look specifically at the financials. And we're going to talk about the financials here momentarily, which are down over, again, 1.33%. Really, you know, in this evening's video, there's 2 key points that I want to make, and one of those we'll kind of kick it off with here in a minute. It's what I call volatility, or lack thereof. The other key point is, you still looking for that Christmas rally? Because, well, we're going to show you a couple of stocks maybe that you should keep an eye on. Again, by large, the rally kind of fizzled out a little bit today. You know, throughout the course of today's trading session, I have to say on an intraday basis, I really wanted to get long. Even down here at 25, 83, like, oh, I really want to get long. But the fact that the financials were so incredibly weak is completely, it's prohibited me from wanting to get long. And again, when I say I want to get long, like again, everything is cruising back to the upside in the S&Ps. But the financials down, though, 1.33%. I'm sorry, that's not going to be my capital put at risk to be able to get the long, that marketplace on an intraday basis. Moreover, if you take a look at the energy sector, it too down by 1.5%. It doesn't exactly instill confidence to get long this marketplace. So, what gives? How did the S&Ps rally? Really, the S&Ps rally, and most of that was predicated on the fact that the monsters of technology. Now, the monsters of tech, that's lo and behold, that's a symbol that I happen to create, and it's just a composite symbol of Microsoft and Apple and Facebook and Amazon and Google. And, put those parts together. What do you have? Well, you have the larger sum of the Nasdaq, and that is what effectively rallied today and really brought the S&P futures a bit higher and off the bottom. Nevertheless, there's still quite a bit of broader weakness out there. With that, let's tune into the financials for just a moment, because there's a few points I want to make about the financials. So the financials, as I kind of stated in this weekend's video, have broken through the bottom of what we term this volatility box. And again, the volatility box is just, wild vol, but still a relatively tight range. Now, here in the financials, what I really want to kind of zoom into is the previous week of trade. This is one, okay, where we started at 27.50, 1, 2, 3, 4 days of trading. Remember, last week actually broke down to only 4 days of trading. What was the kind of the high to the low? Well, we really had a range from right around 27.50 all the way down to effectively, $25. So about a $2.50 range, again, to the downside, neither here nor there. Now, with that kind of a move, $2.50, you would expect that volatility inside of the financials, and in large part inside of the broader marketplace, would possibly explode. Did it? Well, this is what I wanted to do a little regression analysis with you, because I've been incredibly bothered by this, and I've been one of the people that's been out there, I'm like, listen, I'm a big time premium seller, but I'm not going to run out and I'm not going to sell premium until premium really starts to make sense to sell. And let me elaborate upon that statement. Like right now, the premium doesn't exactly make sense to sell. And the reason I'm bringing this up is, again, I know we're here on December 10th, but I'm actually going to cruise back to the 1st. That's the 1st of December. Why the 1st? I just bringing you back to the previous Saturday. Why? All right. Because I want you to look at what 6 days of trading, okay, holds. Well, 6 days of trading typically has about a 75-cent expected move inside of the financials. Now, granted, that was last week of trade. Okay, and there's a reason I'm showing you last week of trade, because you now know, based on what I just told you a moment ago, did we move 75 cents in the week? No! What did we move? Oh, about $2.50. Okay, 75 cents goes into 250. What is it? 3 and a third times over here. So 3 and a third times. I mean, this is crazy, because that's how many standard deviations we moved. Like, if you look at this from a statistical standpoint, so you're supposed to move in this 75 cents range, and that's 75 cents higher, or, for example, 75 cents lower. We don't move in a 75 cents range. We don't move, in a $1.50 range. We don't even move, again, in a $2 range. We're moving out here $2.50, which is way outside. Again, it's almost like a statistical anomaly, if you will, of how much we effectively moved on the week. But then you would think that the next week, the market just saw this immense amount of risk. Okay, would the market get it right the next week? Well, now, and that's this week. Okay, and this happens to be none other than, Friday. It's December 7th. Okay, that's December 7th, and you're looking at about $1 expected move. Okay, well, the irony is, once again, would you want to sell premium in an environment where, first of all, it was pricing a 75 cents of movement? It got that wrong. Okay, now it's pricing $1 of movement. Clearly, volatility picked up. Okay, but look at the range just today. All right, on the XLF. I mean, we moved like 80 cents today. Right. The expected move now is about 87 cents, coming off of, again, some of these wild moves. This is what I'm trying to, elaborate upon when I say, volatility or lack thereof. Okay, another area that you really have to consider, and again, this is not true in every product, but in some of the major sectors like the financials, like the S&Ps, like the Nasdaq, I mean, the energy sector, the volatilities, okay, they're not making sense. They're not expanding enough to make the juice worth the squeeze. The juice means the premium sale. And this, by the way, this is not a case for being bullish or bearish right now. This is a case for, if anything, okay, we could be market neutral. We could be selling calls. We could be selling puts. And you're seeing 3+ deviation moves. You should really kind of feel the fear. And we're similar in context to the S&Ps. As we come into the cash close over here, this is of course, the SPX, and the SPX for the remainder of this week. Okay, now granted, this is the remainder of the entire week. The SPX is expecting about a $63 move. There's the closing bell. So the SPX for the remainder of the week is expecting about a $63 expected move. What the bid and offer over here, which obviously this is not, shares, but I just wanted to show you from the high to the low, you've gotten that kind of movement when? Well, today. We've passed through Monday, and we're already seeing, this drastic expected move. Now, the entire week is expecting about an $82 move, and that's going back from, of course, last week. So don't let these expected moves kind of get you thrown off course. All that I'm saying, with this is what the market is anticipating risk to be. That's what options do, right? They anticipate and try to handicap what the risk is going to be for the next 4 days. And right now, given this is just the remainder of the week, the next 4 days, they're only expecting like a $63 move. But we just blew that away. Again, what do we call this? We call this Monday. Now, granted, the market did end massively unchanged today. I know the S&Ps are up 6, but that's massively unchanged when you have a 60 or 70 point move. So we continue to stress that the sale of premium must be incredibly selective, and right now appears to only be viable inside of equity products, as index products, again, have a lack thereof pertaining to volatility. Another area that we could take you into a little bit, when I say like a little bit of a lack of volatility, you notice I didn't even really bring up the VIX. The VIX today, with the marketplace breaking down, yawned and got to almost 26, but collapsed right back down. I mean, some fairly wild movement in today's trading session, and the VIX, okay, again, it contracted on the day. Or you could take a look at what we call the VVIX. That's the volatility of the volatility index. Would you know that the marketplace is selling off right now by looking at the volatility index? Quite the contrary. You'd actually think that things are fairly rosy with this. And again, there's some disconcerting areas. Okay, I could get deeply into skew, which I brought up a little bit on the weekend video and brought up a little bit live in TheoTrade today. But again, there's a lot of disconcerting areas when it revolves around the sale of premium. Things just look far too docile for the kind of sell side activity that we're seeing inside of the broader markets. Before I get into the Christmas rally here, and that'll be just a quick thought. There's some gravity points obviously in play for those of you aware, maybe not aware. 2626 is for the most part, okay, we opened, crested into 2626, sold off, bounced to it, sold off, okay, kind of bounced around the 2626 handle, took off to the upside. It wouldn't surprise me to see this 2626 come into play again in the afternoon trade. The other gravity point that's I think of critical importance would be 2575. And again, these pertain to the S&P futures at 2575. Well, the reason that one is of critical importance is, well, when it comes down to it, we don't have anything below 25.75. Why? Because we haven't traded down there in a really, really long time. So gravity points are discerned through regression analysis, and there's nothing to do any regression analysis on. We're not going all the way back into, mid to early 2017 to get regression analysis. It wouldn't be effective because trading firms are no longer rolling their risk forward at that point. So you have to be aware, okay, that 25.75. Well, what is being held on the other side of 25.75? And this is where, again, I stress my belief, my opinion is if we do crack below 25.75 here in the near term, this is where volatility absolutely ignites and explodes. And that's I think one of my larger fears right now of going out and selling premium. All right, switching gears a little bit. And everybody right now, of course, is discussing the Christmas rally, which hopes and dreams are fading away. And I think one of the things to display on the idea of the Christmas rally, okay, and again, most people have picked up on this, FedEx and or UPS. If you haven't looked at these charts in the last few days, they're getting absolutely decimated, okay, in their best, if you will, season, meaning coming into December, okay, it's package mania. Have you looked at like Amazon lately? They're not doing all that well either in terms of stock valuation. When it comes down to it though, FedEx, again, absolutely decimated. Take a look at this on a year-to-date percentage. Forget about the fact that they're down, okay, 25% year-to-date. The magnitude of the drop, they were only down, in the neighborhood of about 8% just a few trading sessions ago. Effectively, the stock has lost, almost 17, 18% in 1, 2, 3, 4, 5 trading sessions. And today, it even bounced. That would, of course, be, again, FedEx down 25%. UPS, okay? UPS off by the tune of about 15%. Now, the reason that I mentioned these underlyings is as this week progresses, we had an attempt at a bounce today, okay? If there's going to be a decent rip your face off rally this week, these are stocks that you want to actually be long for those rallies. This may actually set up for a beautiful intraday trade. The only thing that you have, okay, you really don't want to hold these things much longer, okay, than a couple of days at most, because you have the earnings announcements also right around the corner. So if you do want to go out, you want to hold something like FedEx for just the next couple of days, first of all, you don't want to mess around, do not want to mess around with the 11-day options, the December 21st, because that would, again, it would encompass the earnings announcement. Those options are going to be stubborn. Their volatility is going to stay high. If you wanted to hold a position overnight, use a spread. Do not just go out there and buy a call because you think a rally is coming. Why? You're going to buy a call, and at the hint, okay, if you even smell the idea of a bounce coming in FedEx, they're going to crush the volatility out of these options. And all these options are right now is volatility. Okay, they're going to crush the life and soul out of this option. This 40% IV will be 30% IV overnight, okay, which really takes out like, almost 30, 35% of the premium of these options would be gone. So there in case, use a spread. This is what a spread looks like. It's $2.50 wide spread for about $1.27 debit. Use spreads because the spreads, you're both buying volatility and selling volatility, offsetting the effects of the volatility crush. Again, all eyes on FedEx and UPS if you think those Christmas rallies are going to be here. Thanks everybody for joining us at TheoTrade. Have a wonderful evening. Bye-bye.